Doing business in Africa. You can't afford to be without Africa Investor.
What are today's biggest constraints and most promising opportunities for scaling private sector investment in renewable energy and in the green transition in the continent?
No, thank you very much, Chair, and good afternoon to everybody. It's a real pleasure to be here. As the Chair mentioned, my name is Dr. Hubert Danso. I'm the CEO and Chairman of Africa Investor. We are an institutional infrastructure investment platform for institutional investors, particularly African pension and sovereign wealth funds. I personally sort of work very extensively in the sustainability space. I chair the Sustainable Markets Initiative Africa Council, established by His Majesty King Charles III, which brings together about 300 CEOs from around the world to use our own balance sheets and ecosystems to allocate to the sustainability agenda. I also was the first chair for the African Union's Continental Business Network, which really brought together the private sector to drive the cross-border infrastructure project, particularly those as part of the PEDA program, and I also chair the African Sovereign Wealth and Pension Fund Leaders Forum. My perspective is pretty focused on the role of the institutional investment community, the long-term investors. I have a pretty narrow view, actually, because I think the numbers are pretty staggering. When you think about the whole area of renewable infrastructure, the low transition economy from a financing needs perspective, it's way out of the range of development finance. Let's be honest. I mean, if you look at the pools of capital, the whole global collective balance sheet of multilateral development banks is less than $2 trillion. But yet they're driving the private capital mobilization agenda. Does that make sense? Maybe not. And we feel that as the institutional investment community, we've been slightly... Is that the multilateral development banks controlling my mind? Well, anyway, I'll continue. But the point I'm trying to make is that in all of the agendas, as we talk about renewables, green infrastructure, and this agenda, Africa alone needs $3 trillion for our nationally determined contributions. Now, how can a global balance sheet of 1.5 trillion, mobilize and crowd in institutional capital? So I think it's time really for us, and that's the decision that we've taken as the institutional investment community, pension funds, sovereign wealth funds, and others, that we really need to play a bit more of a leadership role. I mean, we've even gone so far as to characterize, and you asked me about the challenge, we've even gone so far as to characterize the problem as a systemic, on the continent, we think there is a systemic multilateral private capital mobilization market failure. And the numbers, we believe, bear that out, because we have a very important role to play, and I think we all have to be figuring out how we can all work constructively together for the future. And, if you look at the private capital mobilization ratios, according to the mandates of the multilateral development banks on the private capital mobilization agenda, they're supposed to mobilize $10 of private capital for every $1 of MDB finance proposed. That's in the Hamburg Principles. It's in so many of the other initiatives that I was involved with. I sat on President Macron's new Global Financial Pact Finance and Private Sector Task Force. We've gone through this several times from many different angles. And there, the actual result is that instead of mobilizing $10 for every $1 that's provided, is actually, according to the G20 CAF report, Capital Adequacy Framework report, the mobilization ratio is actually 20 to 38 cents gets delivered instead of $10. So I think there's actually a crisis there. We think it's a market failure. We don't think that soft tones of let's reform are going to get us there when the pace of this crisis is right on our doorstep. So we think to get to scale, Africa must really take a different view. We must send a very different market signal to the global investment community that Africa is a competitive destination for all of these new green technologies, renewables, green infrastructure, with our superabundance of all of this natural capital. So our sort of mantra is that first things first, in this competitive world, we must stop trying to make investment developmental. and we must make development investable. We need to flip this on its head. We're competing with all sorts of global opportunities. It's not just a little nice pocket of opportunity for a certain part of the market. And we think that if we can change that narrative, we can more smartly align the $3 to $7 trillion worth of nationally determined contribution projects and with the 300 to the 425 trillion pool of institutional capital, instead of relying on the $1.5 trillion balance sheet and deluding ourselves that actually private capital can be mobilized at scale. So we believe that governments should really shift their mindsets from a project logic to an investable asset class and institutional investor public partnership mindset. Because we believe that's the only way that you can get the dual benefits of, one, being able to mobilize private capital at scale, and two, being able to deploy it at speed. What are we really saying? We're simply saying that, you talk about renewables, then you talk about green infrastructure, but we allocate to asset classes. There's a certain way as financial investors that we deploy capital, and it's not aligned with the way that a lot of these projects are designed by the institutions that hope to crowd us in. So this is just good friendly advice that, with all of the goodwill of how institutions that don't allocate on a long-term basis are trying to crowd us in, perhaps you might want to listen to us about how we operate and what our investment policy statements and mandates allow us to do, and then hopefully we can really help each other. So it's really about how do we establish, in our view, African green industrial infrastructure as a globally competitive investable asset class. So that doesn't mean make the project bankable and you'll have funding, because there are many bankable projects, but then you've got to compare them with all of the other opportunities out there in the rest of the market, and we have a fiduciary responsibility to pick the best and the most productive and market aligned. So we've established, and I'll just end up quickly here, so we've gone ahead as the African and the global institutional investment community as a collective, working closely with the African Union, putting on our universal owner hat, which is essentially saying that as universal owners owning public and private markets, we can't invest in one part of the world hoping that we are going to be shielded from the negative effects of the other. So we've established something called Green Alpha, which is our own definition and our own platform, which is under development now, of African green industrial infrastructure as an investable asset class. It was launched at the Africa Climate Summit 2 in Addis Ababa just recently. And it's really designed to support the Nairobi Declaration, which is the first time that African heads of state came together at the first Africa Climate Summit and said, as sovereigns, our strategy for the continent around the transition to the low carbon economy and our NDCs is going to need to be led by green industrialization. And I think where we've come in to play our role is to say, how do we make that green industrialization agenda investable? And that's where we've essentially come up with the Green Alpha program. It's based on the African Union's 5% asset allocation agenda and their institutional investor public partnership platform. And the institutional investor public partnership platform was really just borrowed, I'll be honest. It was really borrowed from how the prolific pension funds in Canada and Australia allocate to infrastructure as an investable asset class. They call it PPPs, which is pensions public partnership. How do you sort of enfranchise long-term equity to be able to participate in infrastructure on a cross-border basis? So because we are sovereign funds, insurance businesses, and pension funds, we just basically use the framework as an institutional investor public partnership. So Yale, they pioneered venture capital, as an endowment. The Canadian infrastructure funds pioneered infrastructure as an investable asset class. Norwegians pioneered responsible investment as an asset class. So we're simply saying, the African institutional investment community, working with global partners, are pioneering African green industrial infrastructure as a globally competitive investable asset class. So perhaps I'll stop there just to plant the seeds, just to say that, we hear a lot about the institutional investment community are not interested in participating in infrastructure or in Africa. I think it's quite the contrary. I think what we're basically saying is if we keep having development finance mindsets trying to structure projects for long-term asset owners is probably not going to work because it hasn't worked. But what we're saying is if we can work with you around establishing asset classes and really beginning to look at blended investment as opposed to blended finance and really aligning it with some of our mandates, we think that there's an incredible opportunity to be able to crowd in capital at scale and creating a regulatory environment that will enable that capital to be deployed at speed. So I'll leave it there. Thank you.
Hubert, I would like to come back to you. You mentioned a lot of opportunities in your speech. I invite you to take like a couple of minutes to prioritize them so that we can take them home and see what we can do about them.
Thank you very much. I'm not sure you want to take them home very big problems, but yes, let me respond to this, because there's a lot of myths that keep getting thrown around. I a couple earlier. Institutional investors won't invest in early stage projects or won't invest in climate. I don't think that, personally, I don't think there is a pipeline problem. I think there's a structural territorial issue. We studied over 33 project preparation facilities operating in Africa, and we found it's the way that they're designed that's actually the problem. We had developers coming to us saying that sabotage. Anyway, they say we've got this great project, sold our more. No? Okay. I must be saying something interesting. I've got a great project. I've invested in it for so many years. I've finally found a development bank that does project preparation. I go to this bank. I've shown them all of my work. I've shown them that I've put X million, friends and family money has gone into this. And they're asking me to take a very big haircut on all of the work that we've put in to come into the project as a development finance institution on a project preparation facility. And then on top of it, they say, we'll do, say the budget's 5 million for the rest of the project development work. And this is a project preparation facility. They then say, okay, fine, you put in 2.5 million, we'll put in 2.5 million. And by the way, you spend every dollar of your 2.5 million from a development finance institution project preparation facility before we put in our $1. This is how the private sector is treated. So I think there's a philosophical issue. It's a structural issue. It's a very unreasonable issue that the way that the private sector, from the SME developer right up to the larger player, is dealt with. And I think I think creating more project preparation facilities is not the issue. Within our own portfolios as institutions, we already have companies that have projects getting backed up and backed up and backed up, not getting the PPA signed. So there's a lot of projects already in our portfolios. There's a lot of technology already in our portfolios. But if you go for an NDC project, for example, you can't originate as the private sector an NDC project because it's not going to be UNFCCC classified, and it's perceived to be between Ministry of Environment and UNFCCC. So I think the structure needs to change. The private sector can come in at a very early stage. We have many developers that could come in and solve a great number of the project development requirements. We don't call it project preparation. That's just a facility name for something else. We call it project development, taking it from concept right through to financial close. So I will just end by simply highlighting another point, and I'll make it very simple because it's a costless action that could have priceless impact. And they've just been discussing it. We just put out some work on it around the G20. It's data. Our institutions can allocate a lot more if we have a different view on risk. Everyone's talked about risk, the perception of risk versus actual risk. There is the Global Emerging Markets Database that sits with a number of multilateral development banks, and they are not sharing that information. And as a consequence, governments are spending about $15.6 billion each year in excess interest. But the interesting thing for us as asset owners is that because we don't have access to that data, and we've been under-allocating to certain markets, Africa and emerging markets, we, over the last 2 decades, have lost about $6 trillion in unrealized returns when you backtest the data. So the one thing I would ask the Commission to do is to really act on a directive that the G20 heads of state have already given to the GEMS consortium to democratize that data. It will give us a much different perception on the risk that will be able to go into transition-related assets. And I think that's just, it's a costless action that can have priceless impacts. I don't want to give everyone complications, but let's see, if we can't do the simple things that are costless, then there's no point in going into the complex ones. Thank you.
Thank you, Lionel Dieu, Agrify, fee management company. That's Rodrigo. I have a question to Mr. Danso. You mentioned in the beginning of your introduction the mobilization and the $10 that moved to 37 cents. 32. All right, it's even less than what I thought. Can you elaborate a bit on how you moved from 10 to 32 cents in terms of analysis? What happened? You were thinking that the mobilization was higher than what it was in practice. Can you elaborate a bit on the shift from one figure to the other?
It's a range.
It's a range.
Between 20 cents and 30 to between 30 and 32. It's the higher range.
All right. Okay.
That's the actual mobilization.
Right.
It's actually mobilized according to the capital adequacy framework for export. That's the number. 20 to 30 plus.
Got you. Yeah.
And the 30 plus cents are the outliers. Average is closer to 25.
Okay.
Actual point, which included the former treasurer.
Thank you.
Yes. Well, all I can say is I think you answered my answer for me in terms of the standardization, but there were, and I'm happy to share the Green Alpha report because it went very deep into a lot of these particular issues around, all of the regulatory compliance related issues and the actual constraints and the myths and what can actually be done. And a lot of that has got to do with the standardization. But one of the proposals that we've made actually to the UNFCCC and a number of others is we can fund the growth of developers already in our portfolios to be able to access some of these new markets around a new arrangement linked into the NDC projects and come up with some new arrangement and work with the regulators to actually accomplish what we would call an appropriate solution. But it's very clear that there is that this can be done in a Basel compliant way. That was one of the very first questions that were put out to the team that actually had to address that. And I think this whole issue coming to the second issue is it's a territorial issue. There is no reason why companies have to go through what they have to go through. I mean, to call it what it is, there is a philosophical difference between the views that the development community have about the role of the private sector in so-called development and the views of the investment community about our roles in development. We are long-term investors. We're creating economies. We're already involved in development. We're universal owners. In terms of the climate agenda, our primary focus in many respects, yes, we have to get optimal return and deliver against our fiduciary responsibilities. But, everyone's now beginning to think about how do we make sure that ESG and all these things are dealt with. For us, I mean, the E, is the NPV of S. In other words, you can't just go and invest in things for the environment just to get that tick in the box. We have to think about lives and livelihoods and all the rest of it. So we are one of the best long-term players to actually be able to participate and allocate for the medium to the long term, for the just transition. But there is this very strong relationship, this very strong narrative that gets peddled that you can't trust the private sector, you need a development finance institution or a development partner in the middle, when actually the real failure of the capital not being mobilized is the same institution that's advising the governments. So we think that it should just be democratized, data should be democratized, and we think access should be democratized. So whether it's that committee putting in money that needs a certain return on private capital mobilization, open it up to other parties. But there is right now, we're selecting the worst track record for private capital mobilization to lead in private capital mobilization on the climate agenda when we need a certain level of emergency. The Belém roadmap needs 300 billion from the private sector. At the same time, the multilateral development banks are being criticized for not being able to mobilize private capital. Who has been given the responsibility to mobilize the 300 billion? The same institutions. Where in the private sector, there are a number of institutions that could definitely get to the 1 in 5, if not the 1 in 10. And I'll close with the number. The number is that if, just to my colleague's point, he had an interest in the ratios, the data shows that if you can just move from the 20 to the 38 cents on the dollar to $5, which is half of the $10 mobilization for the $1, that again adds the $800 billion worth of headroom capacity to MDBs and $7 trillion in extra private capital mobilized. So these are big stakes. This is a big game. And this is where we think that the Commission would not lose anything by just understanding that for the future that we all want to share, we just have to move some roles around. And the institutional investment community is prepared to play that role. I think maybe the development partners may have to play a slightly different role, but we're not trying to take over the whole space. We're simply saying for the private capital to be mobilized at speed and scale.
Doing business in Africa, you can't afford to be without Africa Investor.